Good evening, everyone, and welcome to Entrepreneurship 101. We're so pleased to see such a great crowd tonight. Just a note on that video, for those of you who are really new to financial planning, I think the lecture that's coming now will really help. But later on, we don't have time to cover in Entrepreneurship 101 sales forecasting, but there's some great videos online in the Best Practices series, and we've got two workbooks, a bottom up and a top down for sales forecasts, because they are very integral part of your business. And just a note on the speaker, Charles Plant, he's actually, he used to be the CFO of Mars. He's a serial entrepreneur, and we lost him. He's now bootstrapping his next startup, and he will be coming to talk, to do the bootstrapping lecture again this year. That I see some people nodding their heads. They saw him last year, and mark my words, one of the best speakers we have, and will really inspire you. You'll find him really great. So that's his accounting side, but might be over. Some people might be like, yeah, it's not that interesting, but when you hear him talk about entrepreneurship, you'll just be like, wow, he's pretty cool. So I have a number of announcements that I wanted to make before I introduce our speaker, Andrew Graham. Just one quick note that the Upstart competition, it's coming up quite quickly. The deadline for the applications is February 3rd, which is next Friday. We do ask that you have attended 20 or will have attended 20 of the 30 lectures of Entrepreneurship 101 by the time the competition happens. So you should be attending quite frequently if you're planning on applying. That's why we have the stamp cards for the Upstart competition as well as for certificates at the end of the year. If you're interested in learning the rules and eligibility, it's marsdd.com/upstart. On that page, Marielle has put a link to our executive summary workbook. So we've had a lot of questions. I don't know how long to make my executive summary, what to put in it. So we put some materials on there that will help you. And so that's the Upstart competition. We usually have about 30 people apply, so your chances are pretty good, and we really hope that you're excited about the competition, and even if you're quite early, apply anyways. It can only help you take your business to the next level. The other announcement that I'd like to make is we get a lot of people asking, where are the videos? Where are the Entrepreneurship 101 videos? So I'm going to show you a couple ways on the screen of where you can find them. If you've signed up for the course via the website and you're getting our weekly e-newsletters, there is a blog in there that if you click on that blog, you've got last week's video. But a lot of people have trouble finding, sorry, I got the wrong one. The videos just generally. So on the Mars, this is the homepage of the Mars website. If you go into the videos section, and you go down to the series listing of Entrepreneurship 101, you'll find there's 113 videos there. So we've got past years, and we change the speakers and stuff. So if you want to hear a different approach, or older lectures, lived it lectures like Harry Rosen and Michael McCain, all that stuff is in there. Another way of finding it, finding the Entrepreneurship 101 lectures is in the Entrepreneur's Toolkit. We have an Entrepreneurship 101 section that just has the lectures, not the lived it lectures or Meet the Entrepreneurs. It just has the content. So say you click value proposition, you'll get Joe's head cut off. He doesn't look like that. But you'll get the video, and you get some reference material and some related stuff, and the slides and things. So you can see the slides are right here, and there's articles and workbooks and stuff. So, so they're in a couple places, and we hope that helps you find them easier. And my last announcement is that next week we have another Meet the Entrepreneurs, and this is for social innovators. We have 3 entrepreneurs coming. The first is Seema Pabari, the owner of Tiffin Day. We have Petra Kasun-Mulcha, who's a social entrepreneur, and I'm never going to get the company right. It's Zugunru. And Paul Bichler, CEO of the Eco Laundry Room. So if you're interested in the social entrepreneurship space, or you're a clean tech or ICT entrepreneur and you kind of cross into the social entrepreneurship space, I think it'll be a really great session. We're going with the format that we've been doing this year, which is starting at 6 and doing a longer session to 7:30 to get lots of question time in, and then we'll have a networking reception after. So with that very long introduction, oh, I forgot to announce one more thing. So Mars Media, who's here every week taking these videos for us, has kindly donated another prize to the winner of the Upstart competition. They're donating a video prize. So you have the opportunity to make a short video with them. The prize is a certain amount, I think it's like an hour of studio time and 2 hours of post-production, which is valued about $1,000. This can be used for whatever your company needs. Do you need a short 30-second video that shows how to use your website? Do you need a minute pitch video to customers, to investors? And it's not just you talking to a camera. Video is really powerful because you can show things. You can get your customers talking. You can show value in other ways rather than just you pitching. So it's a nice addition for those that will be pitching to investors or customers. I get people actually who pitch to be speakers to me, and every once in a while I get a video and they're like, oh, here I got one today from TEDx. Some guy who did TEDx in France sent me a video and said, hey, this is me speaking. I'd love to speak at Mars. So videos are a great pitch venue, and we just want to thank Mars Media for giving that great prize to our Upstart winner. So now, yay! So now after the really long announcements, so Andrew Graham is our speaker tonight, and he will be speaking on financial planning. Financial planning is integral to your business. I think a lot of people get overwhelmed because they figure, you know, somebody else will do the numbers for them, but it's a really important part of the business and can be quite exciting as you see the business grow and get more complicated to know how the money's coming in and going out. We know Andrew because he has been a volunteer advisor in our clean tech practice. He's recently become more busy as he's taken a position as Senior Director Corporate Development with George Weston Limited, which is one of Canada's largest publicly traded companies. There he works on structuring and negotiating complex transactions. Previously, he worked for Nortel, where he worked on the divestiture of multiple business units during the company's restructuring. He holds an MBA from Harvard Business School and an MA in economics from the University of Edinburgh. And before he did his MBA, he worked as a strategy consultant at the Tata Group in Mumbai, India, and as a senior political aide advising on policy and communications to a number of federal cabinet ministers in Ottawa. So he's got quite a wide range of experience, and this is actually his first time speaking at Entrepreneurship 101, so we're really excited to have him. So welcome, Andrew.
Thank you. Hi, everybody. This mic sounds like it's on. First of all, thanks for coming out tonight. I know in the sort of universe of entrepreneurship, financial planning may not be at the top in the sort of sexiness chart. If you think of sort of technology and presenting to investors or wooing customers, financial planning may be not quite as exciting as those things. But I hope tonight you'll get a better understanding for why it's important and some insights into how to tackle it, at least from sort of a high level. And I'll talk a bit more about that in a second. I want to start off with some thoughts on finances from, I think, really one of the world's smartest business thinkers, and that's Dilbert. So Dilbert's confronted here with someone talking in sort of really fancy finance language, and I just sort of want to start off by asking, in the audience here, are people who feel sort of really good about finance and financial planning? Who feels sort of, yeah, I got an idea of what it's about, and then who feels that it's probably an area where they need to focus on more so in their learning? So first of all, who feels really good about sort of financial planning? Okay, a few people. So everyone else, you can go speak to them afterwards, hire them as your CFO. Who feels sort of pretty good about financial planning? Okay, that's great. And who sort of feels that this is an area where they need to work on more than others? Okay, great. And I think tonight's talk is really aimed for those who feel sort of okay about it and less okay about it, and hopefully we won't bore the experts in the room too much. And I titled the talk Financial Planning for the CEO. So this isn't designed to make you an accountant or make you an auditor. What I hope to do tonight is give you some of the key questions or key areas that you need to think about as you're thinking about starting your business. So I understand you're not going to be doing finance full-time, but I think there are some key things you need to think about if you're going to be successful. Okay, and so why is financial planning so important? Well, maybe the broader question is, why does money matter to startups? Okay, it kind of sounds like an obvious question, but I think there's a few different reasons here. The first one, so why does money matter? Well, you need to pay bills. Okay, if you want to hire people or buy stuff, you've got to be able to pay bills. Sounds kind of obvious. Second reason is I think being able to generate money is the sign of a successful business model. So you could have the best technology out there, and I'm sure you've heard this in other lectures, but if you don't have a business model around it that brings in money, you're not going to be able to survive. And I think if you think about some of the great technologies out there today, they're often paired with great business models. So, who owns, iPods or iPhones in the room? So I think it's great technology. I think we'd all agree it's great technology. But I think the real genius around the iPod, for example, is the business model, the way that it's paired with iTunes, and that Apple got music companies to sell music at very low prices, and that drives the sales of the iPhone and iPods. So there's a revenue-generating business model around the technology. And being able to generate money is a sign that you're doing something right. And then the final reason I think you want to care about money is that for many of us, for many people who are in startups, it's a goal. I mean, who wants to sort of get rich off their business idea? I mean, hopefully everybody at least sort of hopes that that's an outside goal. Okay, so as we sort of dive into the content here, there's really three things we're going to be talking about this evening. We're going to talk for a while about what an income statement is. We're going to talk about how to forecast cash flows and why that's important. And we'll touch very briefly at the end on a balance sheet and how to think about that. So first of all, starting with an income statement. I think the most important thing to remember with an income statement is that it's a view over a period of time. It's saying how well did your business do financially in the last year or in the last month or the last quarter. And we'll see that this is different from a balance sheet, which is really a snapshot of a point in time. It's sort of how much stuff do you have today. And I think the best way to understand an income statement is to look at one. And I think many of us think that income statements for big businesses are really complicated. And I think that that's often not the case. An income statement, even for a big business, should be relatively easy to understand. So I've picked a company to look at today that's in the news. So that's Research in Motion. And here is their income statement for the fiscal year that just ended. Okay, so if you go on the website and you download their annual report for 2011, this is the consolidated income statement that you'd see on the website. So I've changed very, very little. And what I want to do over the next few minutes is go through this line by line and talk about what these lines mean and why this is relevant to you as an entrepreneur. Obviously, you're not running companies like RIM, but I think the same way that a big business thinks about income statements is useful for an entrepreneur. Okay, so let's start at the top here. So we have revenue. So revenue is simply your sales. It's the money that comes in the door from whatever you're selling, if it's services, if it's products. So if you think about RIM, what are their sources of revenue? Any ideas? So selling hardware, selling devices, that's great. I think the other way that RIM generates money is through services. So support, BlackBerry Enterprise Server, that kind of thing. So all of that goes right to the top. That's whatever your customers pay you. Now, when we think about revenue, I think for a startup, just like for a big business, being able to forecast what your revenue is going to be is really one of the key challenges you have. Because being able to show to investors how much money you're going to bring in is really key. And we heard in the video before, there's sort of two big ways to do this. The first is top-down. So that's saying the market for smartphones in the world is X billion dollars, and we think we're going to capture 10% of the market. For RIM, unfortunately, that number is declining over the last few years. So that's top-down. It's saying, let's look at the market from the top and how much are we going to capture of it. The other way is bottom-up. And if you're doing bottom-up forecasting, you're actually looking on a customer-by-customer basis usually. You're saying, I think I can sell this many BlackBerries to Bell. I think I can sell this many BlackBerries to Rogers. And you sort of add those all together and you get your revenue number. Now, if you're an investor, which of those do you think is going to give you more confidence? Who thinks the top-down model is going to give you more confidence if you're an investor? What about the bottom-up method? I think you're absolutely right. I think if you can go in and show potential customers and say, here's why I think Rogers is going to buy this many, I think that gives you a lot more confidence compared to a top-down sort of, I'm going to capture 1% of the market. So now we'll go to the next line. So cost of sales. And I think this is where things start to get a bit challenging. So cost of sales are costs that relate directly to producing the good or service. So part of the challenge in an income statement is separating what goes into cost of sales from operating expenses. So with blackberries, if you're making blackberries, what do you think goes into the cost of sales line? Anyone in the front row want to, or anyone want to guess? Right, manufacturing. So either you're running your own plants, in which case you've got to buy parts, you've got to pay the manufacturing workers, or you're contract manufacturing, you're paying someone else to make them for you. So that goes into your cost of sales. And as we'll see in a minute, there's a lot of things that don't. So the pay of your CEOs, is that directly related to manufacturing a BlackBerry? No, it's not. So that stays out of cost of sales. Now cost of sales, when you subtract that from revenue, that gives you really a key metric for a business, and that's gross margin. So that's saying once you've produced something and sold it, how much money is left over for all your sort of overhead costs, for all the non-direct costs for running a business. Anyone want to do some quick math here and see guess what the margin is? It's about, for RIM, about 44%. Okay, so on every dollar of BlackBerry they sell to a Rogers, they make 44 cents of gross margin that they can then use to offset other costs that they have. So that's not the money that they get to put in their pocket and pay to their investors. That's the money that they have left over to cover overhead costs, things like expenses like their CEO expense. Now, if we think of different companies, so LinkedIn, do they have physical products that they sell? No. So virtual company, do you think their margin is going to be, their gross margin is going to be higher or lower than RIM's? Higher, right? They have very, very little in direct costs. And so their gross margin is 81%. So Toyota, do you think Toyota is going to be higher or lower than RIM? Right. So Toyota's got lots of cost of sales. They're selling these cars for, $20,000, and it may cost them $15,000 or more to make the car. So Toyota's gross margin is only 13%. So I think you can tell a lot about a business by what its gross margin is. And as you think about your own business model, are you a high gross margin business or a low gross margin business? And it's not to say that one is better than the other necessarily, but it's important as you think about your business model what you are. One thing, one way this is relevant is if you were going to have, let me give you an argument for why the Toyota model is in some ways safer. Because I know 13% looks like a low number. If you've got a lot of operating expenses and something happens to your sales, and you're depending on those sales with a high gross margin, that may mean that you get into financial trouble more easily. Because the nice thing about cost of sales is if you stop selling things, your cost of sales goes away. Whereas your operating expenses, like your overhead, doesn't. Okay. So moving on down here, next we have operating expenses. So these are costs not related to producing the goods and services for sale. And we've listed here, RIM lists some of the biggest and most common kinds of operating expenses. The first is R&D. I think pretty straightforward what this means. So this is paying for the scientists, paying for the equipment that they use, filing patents, all the sorts of things that go into producing and commercializing the research and development. Now this is a big bucket, selling general and administrative expenses, which is SG&A. And this is where a lot of things roll up into this. So often you'll have the cost of selling. So if you're paying commission to salespeople, you'll have marketing. If you have marketing expense, it rolls up into SG&A. And then you have administrative expenses. So your fat salary as CEO, for example, would go into SG&A unless you're also on the line during the day assembling the product that you're going to sell. Next is maybe the most complicated or at least most complicated initially, and that's amortization. So if you buy a piece of machinery, if you're RIM and you buy a piece of machinery to manufacture BlackBerries, or I guess in this case, since it's down here, you wouldn't be using it in manufacturing. Let's say you buy a computer for your CEO's desk. You're allowed by accounting rules to not expense that right away. The computer's going to last 5 years. You can actually charge 1/5 of the computer's cost every year. And that's sort of the concept of amortization. Next we have, so moving down from the manufacturing part of your business, the sort of overhead part of your business. Next you get income from other sources. So, and maybe just before we go there, if you take your gross margin and subtract your operating expenses, that gives you your income from operations. Now your investment income is income from other things. So RIM has a lot of money on its balance sheet, and it earns income from those investments. So if you have a lot of cash that you're sitting on, a great problem to have, the interest you earn on that, you wouldn't report that as part of your business unless you're sort of in the business of running an investment fund. You'd report that as other income or investment income. And then finally we have taxes. I think it's clear what they are. The nice thing is paying taxes is a sign of profitability. So even though it's not fun to do it, it means something's going right if you're paying taxes. And then finally you get from all of that net income. And net income is your profit. And maybe sort of just before we leave the income statement portion, it's worth thinking about RIM, given everything in the news the last few days. So these numbers are in millions of dollars. So RIM sells about $20 billion dollars a year of stuff. This is from last year. On that, they made a gross margin of $8 billion, almost $9 billion. Overhead expenses of about $4 minus taxes gives them net income or profit of $3.4 billion. So this is a company that, in many ways people think is in trouble. But it's generating $3.4 billion in profit. So spare a bit of thought, I think, for the two CEOs that have just left. Imagine founding a startup. 20 years later, you're making $3.4 billion in profit. And you sort of get ejected from your role because the market feels you're not doing a good enough job. And I guess a final note about RIM, if you look at their top line sales number, $19 billion, they've been growing that by about $5 billion a year over the last few years. So if you go back 3 or 4 years, it was they went $5 billion, $10 billion, $15 billion, $19 billion. So it's not so bad growth. I mean, if my business were sort of doubling or going up by $5 billion a year, I'd probably be feeling pretty good. But the markets can be tough, so this is another advantage of before you go public, think about this. Okay, so we've talked about an income statement, and we talked about a concept that we talked about amortization, and I think that was a hint that in financial planning, there's a big difference between it's what we call accrual accounting, or accounting that sort of uses accounting concepts, and cash accounting, okay? So when you think of that computer for the CEO's desk, for example, say it cost $100, in the amortization line, if we're amortizing it over 5 years, you're only going to see $20 of expenses for that year. But is that, from a cash perspective, is that a good representation of what happened? Well, the company had to put $100 out the door to get the computer. Even though they're only expensing $20 of it, there's a cash outflow there. Another example of a difference between cash and non-cash accounting. Let's say you make a sale to a customer, you convince a customer to buy your product, and they say, you know what, I've got some cash right now, I'll pay you the cash up front, even though you're not going to deliver the product until next month. In income statement accounting and accrual accounting, you don't actually count that as revenue. So you don't count it as revenue until you've delivered the product. So you've got cash in the door, but you can't count it as revenue. So there's a bunch of differences between what you see on an income statement and what happens on the cash side. And maybe you're thinking, well, listen, this is getting kind of complicated. Who really cares? And I think if you're only going to think about one, I hope I can convince you tonight that thinking about cash is actually the more important way to think if you're in a startup. And to sort of tell that story, I've invented a fictional company here that we'll get into in a minute. And since I'm in the clean tech practice, I thought I'd use a clean tech company that I'm calling Tom's Solar Power Company. And Tom Rand is the head of the clean tech practice, so I thought I'd use Tom's name. And what this company does, it's really simple. Tom buys solar cells. So these are cells typically made in China. And then he sort of works out of his garage to turn them into solar panels. And he uses a very sort of complex proprietary technology to do this in a way that no one else can do. So he's the only employee. He's doing all the manufacturing himself. And the economics of this are pretty good. He buys solar cells for $50 for a panel's worth, and he sells a panel for $100. So what's his gross margin, first of all? 50%. So 50% gross margin. Better than RIM. Not as good as LinkedIn. Okay, so that's the business that Tom proposes to be in. He's got this great technology that he sort of uses to convert this to this. And Tom's done his bottom-up forecasting, and he's projected his sales over the next year to look like this. Okay, so this is, you can see the 12 months of the year, and you can see his sort of sales, his revenue by month going up like that. Who's got sort of a similar looking sales plan for their business? Kind of, right? This is the classic sort of hockey stick revenue curve that people look for. So you go from almost nothing to, by the end of the year, he's selling $400,000 almost per month of solar panels. So these are monthly numbers. So in August, he's selling $100,000 just in August. And if you turn this into numbers, you see that he's selling them for 100. So to make $5,000 of revenue in February, he sells 50 units. So these are just the sort of numerical representations of this graph. And just to keep this simple, we're just going to focus for a second on the first 6 months of the year for our example. So you'll see he's going to go from no units sold in January through to June, where he's selling 550 units and making $55,000 in revenue. Now that's just revenue we call top line, so there's going to be costs that fall below that. So this is his income statement for January to June. And you see in January he's projecting no sales. He says, listen, I'm a conservative guy. It's going to take me a whole month before I generate any leads. And if you look at Tom's business, he's got SG&A of $1,000 a month. And this is the cost to maintain his garage and heat his garage where he's going to assemble these products. And let's ignore for a second complications like depreciation on his garage. Let's just assume sort of a simple world here where he's got real costs, cash costs of $1,000 a month. Beyond that, he doesn't have to pay himself. We're sort of really keeping this to be a simple example. So let's look at February. In February, he's selling 50 units. We said at $100 each. 50% margin gives you a gross margin of $2,500. Off that, you subtract $1,000 for SG&A, and that leaves $1,500 of net income. So that's good, right? I mean, not bad for month 2 for his business. And if you look at how things keep going, you go from $1,500 of net income, $6,500, $11,500, $19,000. By June, he's making $26,500 a month of net income, so that's profit. So who thinks this is a good business? Seems great, right? This seems like a great business. And I think in many ways it is a great business. We should applaud the fictional Tom for putting this together. Now, when I think an idea we can come back to, but when you're doing your planning, you know, Tom's given one projection. Sometimes it's good for investors to give sort of a high and a low as well as your sort of expected case. But let's say this is Tom's sort of expected case. So now we're going to flip from the sort of income statement view of the world, which is the accrual accounting, over to the cash view of the world. So what changes? Well, first of all, we're going to just say for fun that Tom starts his business with a loan of $25,000. So he goes to his friend, he goes to the bank, he gets a $25,000 loan. He says, listen, I'm only burning $1,000 of cash a month. I can go for 25 months before I get into trouble. So this seems so safe and so conservative. Many businesses are lucky if they get, you know, a year's worth of cash burn. Tom's saying, if I make no sales, I'm only losing $1,000 a month. Now, a few other details worth noting. His customers that he's going to sell to, and he's got, you know, a great pipeline of customers, they're happy to buy from Tom. They like his technology, but they say, Tom, listen, we pay in 30 days. Okay, we don't pay you the day you deliver it. You deliver it, you send us an invoice, we'll pay you 30 days later. Okay, that's very standard. Some people will say we only pay in 60 days. And then on the other side, Tom is buying these panels, or the cells rather, and his the Chinese manufacturer says, listen, I've never heard of this Tom guy. I don't know who he is or where he's from. Tom, I need cash up front when you want to order solar cells from me. And by the way, once you place the order, it takes me a month to ship them to you. Okay, and that's reasonable too. I mean, if you're a startup, businesses aren't going to give you 2 months credit necessarily. So now we need to think, well, what do these two pieces of information do to Tom's cash forecast? So if he knows he's going to have $5,000 of sales in February, when does he need to order the panels? He needs to order them in January. Okay, so he has to order them and pay for them in January. So what happens in January? Well, he pays for the panels, so $2,500. He has to spend his $1,000 to heat his garage. So his cash loss is $3,500. Okay, so on the income statement, he only had a loss of $1,000. Now he's got a loss of $3,500 in cash terms. So that leaves him $21,500. Kind of think, okay, well, it looks quite a bit worse from a cash perspective, but sales haven't happened yet. Let's get into the sales. Then things will get better for Tom. So here's the next month. So Tom ended with $21,500. So of course he starts with $21,500. Even though he's completed the sale, there's no revenue this month because the customer takes 30 days to pay. So for sales that he makes in February, he doesn't get the income, he doesn't get the revenue rather, until March. But he has to pay for next month's solar cells. So next month he's going to have $7,500 in sales. So he's got to pay that to his manufacturer. So month 2, his cash loss is $8,500. So this is a business that's doing really, really well from metrics like sales, profitability. It's a high margin business with low overhead, but he's losing a ton of cash. And so we'll keep going. We'll go another month. Now this month, something good happens. He actually can collect the revenue from the first month. Good, right? Money in the door, frames the first dollar bill. But now he's got these big sales in April to think about as well. He's going to sell $25,000 worth of stuff, and that means he's got to put out the door $12,500 for the cells. So even though he's now collecting revenue, he's still losing $8,500 this month. Now his cash balance is down to $4,500. So you can guess what happens next month. He collects the $15,000 of revenue from March, but now he's got to put out the door $20,000 for the panels for May. And he's gone from having $25,000 in the bank to now being bankrupt. So this is a business that looks great from the income statement perspective. On the income statement it says, you're making $11,500, but from a cash perspective, you're losing $6,000. And this is why if you have to choose as an entrepreneur between thinking about income statements and thinking about cash, always think about cash. It's simpler. You don't have to worry about fancy accounting principles. And it's actually much more important to your survivability. Because who cares if on paper you're making $11,500 if you've just run out of money in your bank account? And I hope you agree that this isn't all that complicated. The really important things to know are, how long is it going to take you to pay your suppliers, and how long will it take you to collect from your customers. And so the ironic thing about this business is Tom would have been better off if he had slowed down his sales. If Tom had said to his customers, listen, I can't do $25,000 of product that month. I can only do $10,000, or I can only do $7,000. And I think we can all relate that it must be very hard as a CEO when someone comes to you and says, I want to buy your product, I'm going to give you 50% margin. To turn around and say, I'm sorry, I can't take that sale right now, that's a hard thing. But if you want to survive, you have to think about cash. And sometimes managing your cash becomes more important than getting that sale in the door. And maybe just a final word here, if Tom had started out with a bit more money, you see that things start turning around a little bit by the time you get to June. So eventually, the benefit of the sales starts to catch up with the cash that he has to put out the door for next month's sales. So I think one lesson from this analysis is if you'd projected out the full year, instead of borrowing $25,000, Tom should have borrowed more than that. It looks like from sort of this quick look, he should have borrowed at least $30,000, probably more to give himself a buffer. Okay, so the lesson here we've just said, this is why forecasting is so important. If you're not forecasting cash flows, you're really flying blind. Okay, so we look at this pilot. This doesn't look like a good situation. The plane is inverted after all. But it's hard to know how bad the situation is. Okay, so it's a really bad situation. There's the pilot up there. And so I would say if you're not thinking about cash, you're kind of trying to fly the plane this same way. Before we turn to balance sheets, I want to talk very briefly about EBITDA. Who's heard this term before? Okay, I've always thought of it, when I first heard it at least, I thought it was one of the more sort of confusing terms you hear. To give this, I guess, the sort of fairly simple version, EBITDA, why is it called EBITDA? It stands for earnings before interest, taxes, depreciation, and amortization. And it's sort of like a measure of your cash from operations. Investors care about it a lot. If you want to learn in detail what it is, you can Google it. There's tons of information out there. The simple way of thinking about it is it's like cash. It's like cash from operations. So you're taking your earnings, which is your net income, and then essentially subtracting interest, taxes, depreciation, and amortization. Depreciation and amortization, as we've said, are not real cash outlays. Taxes are cash, but if you're looking at how good a business is, you often look at EBITDA and you sort of say, let's forget about the tax regime. Let's forget about the income it's paying or the interest it's paying to its borrowers. From an operational perspective, what is the business doing? And that's why you use EBITDA. So we'll turn now to the final of the three parts of this overview of financial planning, and that's balance sheet. So unlike the income statement or the cash flow forecast, it's a point in time. So instead of saying, income statement for the year of 2011 or for the month of June, it's on December 31st, 2011. It's kind of like you take a snapshot of all the cash, all the inventory, all the stuff your business has at that point in time. And a balance sheet is getting back into the world of accrual accounting, so the sort of non-cash stuff, and you'll see in a minute why that is. So I've done a balance sheet here for our friend Tom in February. And so you'll recall the income statement and the cash projection from February. And what we can do is just sort of map it across. So Tom ends the month with $13,000. If you were to do a balance sheet for February 29th, you'd get $13,000 in cash. Okay, that's pretty straightforward. So ending cash just goes to final cash. The next thing we'll look at is revenue. So we've said Tom is selling $5,000 worth of stuff, but not collecting the cash. So what is he getting? He's getting sort of an IOU from the company that buys it. So we record that on the balance sheet as accounts receivable. What else is happening that month? He's ordering inventory. He's ordering the solar cells for the next month. So that gets booked here as inventory. And then I've sort of just invented a fictitious number for his building and equipment and for his land. That also goes on the balance sheet. Remember, that didn't matter at all when we were thinking about the income statement or the cash projection. But when you look at his assets, you would include those. And then finally, on his liabilities, you see he's got no accounts payable because his suppliers won't allow him any leeway. He has to pay up front when he orders. And he's also got the loan of $25,000 that he has to eventually pay back. And then you add up liabilities, owner's equity. They always have to equal assets, and that gives you the balance sheet for the business. And balance sheets are important, I think, if you're trying to raise money. If you have assets in the business that you can put against a loan. Given that he had land that he says is worth $100,000 and building and equipment that's worth $50,000, he probably could have borrowed more than $25,000. If he had said, you know, Mr. Banker or Ms. Banker, I want to borrow $50,000 and I'll put my house and my land against it, I think there's a good chance he would have gotten that loan. So a few final thoughts before we turn to questions. First of all, it really is all about cash. If there's only one thing you take away from tonight, it's that focus on the cash. Don't worry so much about what it looks like to an accountant. Think about cash in the bank. Next is do the forecast from the bottom, or do bottoms up forecasting. And as part of that, create multiple scenarios. So if your sales are 10% worse than you thought they would be, what does that mean for your business and for your cash position? What happens if your expenses end up being higher? What if your supplier who promised you $50 a solar panel comes back and says, a solar cell comes back and says it's actually going to be $60. The price has just gone up. So understanding how those key metrics change the profitability of your model tells you where to focus. So if a 5% increase in solar cells is going to put you out of business, you've got to focus your time as a CEO locking down a rock-solid contract with your supplier. If a change in solar cell pricing isn't going to make a big difference, I mean, if you're LinkedIn, your cost of sales is only 13%. If your cost of sales goes up to 14%, that's probably not a big deal. But if you're Toyota and your cost of sales goes up by, you know, just by a few percentage points, that really squeezes you. And the final piece, I think, here is to say, get expert advice when you need it. So I think understanding sort of what you know and what you don't know in the finance area is really key to avoid you making errors. We all have more to learn. You know, when I'm looking at a transaction for the company I work for, we'll bring in very savvy accountants who can do real deep dives into different areas. And of course, we're all resource constrained. It's not to say you can go out and hire a team of financial analysts and a CFO. But when you need advice, when you're looking at things like your cash forecast, that's a great time to draw on the resources here at Mars and bring it in and say, do you think this makes sense? Have I not thought of anything here? And I think that's sort of a key way to protect yourself and protect your business from making key mistakes in this area. So that's all I have. We have about 11 minutes left here for questions. And I'm happy to take questions. I think the request for the folks on the web is if people can go to the microphones and ask questions.
There's one question coming from the webcast, which is an interesting question. If you look at websites online like LinkedIn, what would be factored in for the cost of sale, and how do you go about calculating that cost?
So I think it's a great question, and there's, you know, this isn't a clear black and white area. So companies, you know, and their auditors talk a lot about, you know, what's direct costs of producing your product and what's not. Somebody who works full-time on the line clearly is a direct cost, and you'd count up in cost of sales. But what about someone who's sort of a supervisor half the time, but also, you know, goes back and forth with head office and talks about specs? I mean, there's some judgment calls to be made here. But what do people think? What do people think would go into LinkedIn's cost of sales? Yeah, sure. What do you? Web hosting. Pardon me? Web hosting. So web hosting, I think it's a great example. So they've got all these, you know, servers that they have to pay for to host their site. They probably, yeah, go ahead. What do you think? So marketing would actually fall lower down. Marketing falls in the SG&A line, but great question. I think there's probably also some programmers that they may argue are dedicated to the products that they're selling. Question, yeah?
Following on what you're saying here, when dealing with, say, an information services company or an IT company that's dealing in software, where, I mean, when I first looked at those slides, I thought, well, the R&D cost I would have put up in my cost of goods, because when I'm doing software development, that's my product. You know, paying the software development, getting the software ready before I earn $1 off it. Everything's loaded up front. How does that change the whole equation? It sounds like a somewhat different model from what you did on the solar panels.
Yeah, I think it's a great question, and I guess as I sort of just referring back to my previous answer, there's ambiguity, especially in models like, you know, service models or models like software. So what counts as development and what counts as actually the cost of putting the product out the door. I think, just if I can dodge the question for 1 second, the good thing is from a cash perspective, it doesn't matter, because if you're paying someone, who cares if it's cost of sales or not? So from the most important perspective of cash, it doesn't matter. And then beyond that, I think what you should do is speak to accounting experts in this area. Then there's folks at Mars that can do that to give you guidance on your specific situation.
Is there sort of, I'm a little confused about the two methods. Like you've got your operations costs and then you've got your SG&A costs. Is there a sort of simple rule for thinking about SG&A costs that I can be like, oh no, that's an SG&A cost, put it in the second line?
So SG&A is part of operating costs, but it's not part of the cost of sales.
Okay, so it's costs of sales discretely, and then costs of...
So you can think about it as kind of cost of sales. So what costs are direct costs related to manufacturing or producing my good or service? And then there's operating costs, which is everything else. It's SG&A, it's R&D, it's marketing. There's a whole bunch of things that roll up underneath there. So is it direct or is it indirect? Can you actually tie that cost to a specific thing, like a specific BlackBerry that you're selling? Or is it more about marketing, creating, managing the company, et cetera?
Hi.
Hi.
Yeah, thank you for your talk. I just wonder if you could walk us through how to calculate the net present value and how that connects back to EBITDA.
Sure. So NPV is net present value, and that's one of those terms that the Dilbert character was using on the first slide. We won't necessarily go into a lot of detail here. Net present value, what you're doing is you're looking at all your future stream of cash flows, and you're saying, well, what is that worth today? Because would you rather have $1 today or $1 a year from now? Most people would say $1 today. So as you think about how to value that dollar tomorrow, you use a net present value method to sort of say, what's $1 a year from now worth for me today? Right. And often people will take a series of EBITDA projections, bring it into the present using net present value, and that's a way to value the business. Right. You say, based on these projections of EBITDA, and based on the interest rate I'm using for net present value, the business is worth $100 million. Right. So valuation is kind of a complex part of finance, I think. And again, on the web, there's tons of information around valuation. Yeah, in the front first, and then we'll go to the back.
Hi. How much should one borrow in terms of cost of operation and cost of sales? Is there an equation that we could benchmark as safe?
In terms of how much you should borrow?
Yeah.
Well, I think what I would do first is really project out my cash flows and understand, how much am I going to need to not go bankrupt, would be the first part of the answer. So we saw in Tom's model, if Tom didn't want to turn away sales, he would have had to borrow at least $30,000, and that's not giving him any sort of cushion for error. I think part of the answer is also how much can you borrow? I mean, you can't borrow whatever you want. And I think one of the lessons I was hoping to get across tonight is because you're constrained in how much you can borrow, that may affect how much you want to sell, or that may affect how much you want to produce. So I don't think there's sort of an easy answer to how much should you borrow. It depends on what your needs, what your cash needs are going to be over a period of time.
Okay, thank
Alrighty, hi. So this is going to sound like a stupid question because everybody in the room seemed to get it. But in your hypothetical scenario, just a gross margin is what we're talking about here. If a company's making $1.50 for every dollar that they invested, that's a 50% margin, correct? For every dollar that they spend in costs?
No. So if a company's making $1.50,
bringing in $1.50,
and it costs them $1, so their gross margin would be 50 cents per on revenue of $1.50.
Okay, already. So it's the revenue that's your denominator there, not your cost.
Right.
Okay, thank you.
Just so I understand the nuances of cost of sales. Oh, look, a BlackBerry. If I'm going to develop BlackBerry Messenger 2.3, that's R&D, therefore that's operating expenses. If there's any bugs that have to be put, 2.3.1 or whatever, all of that is still development. As soon as I downloaded this new version in here, that's cost of sale, and if I have to go to a help desk or what have you because there's a problem, that too would be cost of sale. Would that be?
That sounds right to me, but listen, I mean, we're getting into sort of very deep accounting territory here. So, I mean, it sounds, sir, like you've got some experience in this area?
Not really.
Oh, okay.
I'm just trying to get the basic concept that, okay, if you're creating something new or just slightly better, that's more the operating expense. As soon as you give it to them, the something new, and it's now part of the whole package, and you're supporting it as well, if there's, that becomes cost.
Yeah, from a theoretical point of view, I totally agree. And you can see the challenge that companies have in that where do you draw that line, right? So there's challenging sort of accounting issues here, and companies have long discussions with auditors and come to views on this.
All right, Andrew, first of all, that was really good. I'm financial literate, so this is kind of helping a lot. I'm curious to know, when it's a service, like say, for example, you're holding a workshop or something, I'm still trying to understand how the cost of sales and how the different costs you classify. So your time, say you're printing out sheets for people, where does that fit in the costs?
So if you're delivering a service where you're...
Say it's an event or a workshop, or say it's a workshop, for example, and you bring people out and you're printing out sheets for them, and then your time to do the presentation, how does that look in the cost structure? Well,
I think if you can argue that it's directly related, so if you're getting paid to give a seminar, or if you're paying an employee to give a seminar and that's your revenue stream, you'd count his or her salary as cost of sales, and you'd also count the cost of your handouts as cost of sales.
Okay.
I think if you're the sort of CEO overseeing it all, you wouldn't count that as cost of sales.
Cool. Okay, thank you.
And again, just to say sort of one more time, I feel like we're spending a lot of time on this concept, which is great, and we're happy to do it. But from a cash perspective, it doesn't matter, and cash is ultimately the most important thing. Cash is king, exactly.
Hi there. One thing I noticed is that Tom didn't have any increase on his monthlies. It was $1,000 every month. And with all that work, you'd think you would have to hire somebody. And we're sort of sitting in that position right now. I have to do all this work quite quickly for our own startup. And, Tom didn't put any numbers in.
I think it's a great point. I mean, Tom has a particularly good business model, even though he doesn't manage cash well. And I think you want to think about, are your overhead costs going to go up as your sales go up? And I think you could make a good argument that Tom's cause would have. I mean, how can you pay the same electricity bill if you're producing 10 solar panels or if you're producing 100? And I'm sure you're right, he would have to hire someone to help him. So these are all the kinds of things you need to factor into thinking as you make your projections.
Hi.
Hi.
I wonder if you have any suggestions on how to make rock solid financial projections. I mean, you say that the typical projection is the hockey stick ramping of sales, but I'm sure that half the time they don't follow that chart pattern. So I'm wondering if there's the market research, but with my company, I'll be selling things online, and there seems to be a lot of probabilities, or different probabilities as to whether I can actually reach the numbers that I have projected. So, do you have any suggestions about trusting your financial projections?
Well, I think one principle is to be conservative. So if you're not sure about something, make sure you understand the worst case scenario or a bad case scenario. I mean, listen, why do we always see hockey stick projections? Because if it didn't look like a hockey stick, you wouldn't be doing it. You wouldn't be sort of leaving your job or spending your time to work on a business that's going to grow at 1% a year. Right? I mean, so there's a reason things look like a hockey stick. It's because we think we've identified areas where fast growth is possible. And then when it comes to sort of what does that mean for your projections? I think you want to be as conservative as makes sense and understand what the drivers are. So if half your customers don't materialize in the first 6 months, what does that mean?
Okay.
And I'm sort of conscious we're out of time. I mean, I'm happy to take your question maybe afterwards. But one.
Okay.
Oh, sorry.
Sorry, I just wanted to add some comments. So I'm going to post in the LinkedIn group the best practices that we had called Beyond the Hockey Stick, and it's probably the clearest explanation you'll get for sales forecasting. And at the beginning, it shows what, a lot of tech companies, what the actual forecast is, and a lot of, what the assumptions you have to make and all kinds of things. It's a pretty hard question, I think, to answer in a couple of minutes. But if you're on the LinkedIn group or you aren't yet, maybe join our Entrepreneurship 101 LinkedIn group, and we'll post some resources that help with kind of harder topics. But that was a really good video. I think that will help you. Maybe we'll take one last question, and then we'll wrap it up.
I really appreciate that. I thought I'd have to sit down. I know absolutely nothing about funding, but I look at your explanation, and first off, I find it fascinating and really neat, and I enjoy it. But second off, I see a difference between companies that are primarily labor, like software companies, that have a fairly low cost per sale but no assets, and manufacturing concerns, like the solar cell company, that have high cost per sales, but they can take out bigger loans because they have more assets. Are there any other differences between accounting, between like companies that do primarily services or software development and manufacturing concerns?
So I think it's a great question. I mean, another difference that comes to mind that we think a lot about here when I see a manufacturing company, which model do you think takes less money to get off the ground?
I always thought the companies that were primarily labor.
I think so too. I mean, if you've got a software idea, if you can bootstrap your way or pay one engineer or get someone to donate their labor to sit in a room and type out lines of code for a year, you can get a product out in the market. We had clients here who said, who came in and said, listen, I've got a great idea for manufacturing solar cells in Ontario. The problem was they needed to put $20 million into the ground to build a plant to do it. Yeah. So that's a hard conversation to have with a funder. If you go to someone and you say, listen, I've got a great idea for software. I need $100,000 to get 2 laptops and hire 2 engineers for a year. That's a different conversation than saying, you know what, I'm pretty sure I can do this, but I need $20 million to build a plant. So I think that's a pretty key difference. Okay. I mean, I guess maybe just a second piece is when you look at in the last sort of few years, the companies that have made really a ton of money, which ones do you think it is?
I don't know. Apple was in the news today.
So you're right. I mean, Apple's a good hybrid, I think, because it does do manufacturing. But if you look at companies like Groupon or companies like Google has increasingly some physical assets. But I mean, if you look at companies like Facebook, they tend to be asset light because you can scale so much more quickly. If you've got one solar cell plant for $20 million and it's going well and you want to double your revenue, you've got to build another whole second plant. If you're Facebook and you want to double your number of users, your cost of doing that is probably very low. So you can grow exponentially faster if you're asset light.
So I should go into software.
So it's a crowded space, but if you've got the next Facebook, you absolutely should.
Thank you very much.
Pardon me? What's Groupon is not, I think, have they gone public already? Yeah, they've just gone public.
They're valued at some huge amount, but they've never turned a profit.
Right. So you could, I mean, the great thing about public companies is you can go online and look at exactly what their gross margin is and what their cash flow statement looks like and everything. So hope that was helpful.
Thanks so much, Andrew. That was great.